Welcome to This Explainer. Today, we're unpacking a really massive topic in the real estate world, Joint Development Agreements, or JDAs. The financial and legal stakes here are, frankly, absolutely massive. Whether you're a landowner sitting on a prime piece of real estate or a developer aiming to build the next big skyline, understanding the tax implications of these agreements can literally mean the difference between a highly profitable venture and a truly devastating financial penalty. So, grab a coffee and get ready because we're going to decode all the fine print.
Okay, let's dive right into this. Here is our roadmap for today. 1. The rise of JDAs. 2. The taxation timing dilemma. 3. Section 53A explained. 4. The unregistered JDA trap. And 5. A practical JDA scenario.
Section 1. The rise of JDAs, pooling resources for progress. You know, it's basically impossible to look at modern urban development today without seeing these agreements in action. So what is it? At its core, a joint development agreement is the ultimate resource pooling mechanism. It's kind of like a real estate marriage. The landowner brings the prime physical asset, the land itself, and in return, a chunk of the future build is earmarked specifically for them. The developer, on the other hand, brings the capital and the construction expertise, taking the remaining area to sell or monetize directly. And why is this synergy so incredibly popular? Well, it's a huge win-win. For developers, it totally eliminates that massive initial capital hit you'd normally need just to buy the land. Plus, it saves a major chunk of change on stamp duty. With the land secured and litigation-free, all their working capital flows directly into construction and getting government permissions, which means lightning-fast development. And for the landowner, they secure a highly valuable asset in return, literally without lifting a single brick. Moving on to Section 2, the taxation timing dilemma, the income tax trap. Because let's be real, wherever there's massive profit potential, the tax authorities are never far behind. So here's the stark, literal million-dollar question for you. When exactly does capital gains tax apply to a JDA? Is it the exact moment you sign the paper? Is it when the building is finally finished? Or is it somewhere in between? Because the answer to this one question changes absolutely everything about the financial viability of a project. There's a pretty stark contrast between the authorities' viewpoint and, well, reality. The Income Tax Department, in their infinite eagerness to collect revenue, absolutely loves to argue that simply signing a JDA and handing over possession triggers an immediate tax liability. Basically, they treat it like you've completely transferred the property on day one. But let's look at reality for a second. When a JDA is signed, those built-up areas the landowner expects in return are just future promises. Taxing someone on a promise that might stall out, change, or just completely fail to materialize, that creates a massive and a very expensive dilemma. Section 3. Section 53A explained, the rules of the game. Let's look at the actual statutory framework to figure out how this is supposed to work and who actually wins this argument.
So the crucial point here is how the law actually defines a transfer. The Income Tax Act borrows from Section 53A of the Transfer of Property Act to define when a transfer happens under what they call part performance. For this to apply, 4 essential checkboxes have to be ticked. 1. There has to be a written contract for consideration, signed by everybody. 2. The terms of the transfer must be clear and ascertainable. 3. The transferee, so the developer, must have actually taken physical possession of the property. And 4. The developer must have done some act in furtherance of the contract and be willing to do their part. Historically, if all 4 boxes were checked, the law basically said, boom, that's a transfer. Pay your taxes right now. For a landowner, hitting all 4 of these criteria prematurely is exactly the trap you want to avoid.
Section 4. The unregistered JDA trap, the legal rescue. Because actually, it's not quite as simple as just checking those 4 boxes anymore, thanks to the Supreme Court. Let's look at a major game changer. In the landmark case of CIT versus Balbir Singh Maini, the Supreme Court looked at this exact timing issue. The tax department was arguing that giving possession to the developer triggered immediate capital gains. But the court, they held that the owner continued to be the owner throughout the whole agreement. The possession was only given for the limited purpose of development. Think about it. Handing over the keys so a builder can pour some concrete absolutely does not mean you've surrendered your underlying ownership. So just handing over the site doesn't automatically equal a taxable transfer. But here's the real plot twist, and it comes down to a legal technicality regarding registration. Thanks to a 2001 amendment to the Registration Act, the Supreme Court delivered a really dramatic ruling. They clarified that because the JDA in this specific case was never officially registered, it had, and I quote, no efficacy in the eye of law. Basically, if the agreement isn't legally enforceable under Section 53A because you skipped registering it, then obviously no transfer can legally be said to have happened. And no legally valid transfer means no immediate capital gains tax. Talk about a massive sigh of relief for property owners, right?
And the courts actually went even further to protect the reality of how real estate works. What happens if you sign a JDA, but the whole project falls completely through because the developer couldn't get the necessary government permissions? The Supreme Court held that in a scenario like this, no income actually accrued to the landowner. Since the income was entirely dependent on getting those permissions, the developer doesn't legally owe a debt to the landowner if they fail. So, no right to receive income has arisen, meaning, once again, no capital gains tax can be levied on a failed promise. Section 5. A practical JDA scenario, bringing it down to earth. Let's move on and see how this all builds into a highly relatable example.
Imagine a guy, Mr. A. He owns a 200-square-yard residential house and decides to enter into a joint development agreement with the developer. Let's call them XYZ Limited. The terms are pretty straightforward. XYZ Limited is going to knock down that old house and develop a brand new property. In return for giving up the land, Mr. A gets to retain 3 brand new floors, plus the developer tosses in a lump sum of 50 lakh rupees. The developer, XYZ Limited, gets to keep 1 floor to sell or transfer however they want.
So, the ultimate question tying our whole explainer together today is this. How and when exactly will Mr. A be taxed for transferring the land rights for that one single floor over to XYZ Ltd? Based on everything we've just uncovered, Mr. A's tax fate relies entirely on the precise wording of his contract and, crucially, whether the specific agreement was formally registered. If it was registered and possession was handed over, well, the taxman might come knocking sooner rather than later. But if it wasn't registered, the courts have made it incredibly clear that it holds no legal efficacy for transferring the asset under Section 53A, effectively delaying that tax implication. Which leaves us with a really critical takeaway. Real estate joint ventures are incredible, powerful tools for wealth creation and urban development, but they are absolutely surrounded by legal tripwires. A single overlooked signature or a missing registration stamp can completely alter your financial reality overnight. So I'll leave you with this final, provocative thought. If you or someone you know is entering into a real estate venture right now, is your local development agreement properly structured and legally registered? Or are you unknowingly stepping right into an income tax trap? Always seek professional tax counsel before you sign on the dotted line. Thanks for joining me for this explainer. Keep learning, and I'll catch you next time.